Here's the number one indicator that every investor and trader must watch in 2021. Before I show you, my name is Joshua Belanger of countervest.com, and this is another episode of Follow the Money. So we're going to take a look here at the Cboe Market Volatility Index, also known as the VIX or the fear gauge. And you're wondering why this is the number one indicator. Well, no matter if you're a stock trader, investor, or option trader, knowing volatility is essential because volatility creates market ranges, which are also known as expected ranges. Now, if we take a look here at volatility, we look all the way back into March and we see that we hit that all-time high of 85 on the VIX. Now, the VIX specifically, the VIX, is specific for the S&P 500. There are other volatility indexes for other indices, but we're going to focus on VIX today. So the VIX hit a 85 all the way back on the Corona crash, and then we backed off there. We closed 2020 at 23. So that is about 3 points higher than historical average. Now, in context, what that means is that we are seeing higher volatility, even though markets are just a stone's throw away from all-time highs. So let's take a look here at the SPY. So SPY here, we just hit an all-time high of 378, backed off here. So volatility is elevated even though we are seeing prices in the SPY much higher, all-time highs. And that's a big divergence. And what that means is that there's still fear in the marketplace. And if we take a look at today's action, we saw a sell-off. We saw a bit of a pullback. So going in and understanding these expected ranges or what the market is pricing in is going to help traders and investors know and understand expected ranges so you don't get shaken out. What we refer to this as on the floor is shaking the tree. So if you think about people on the holding a tree and holding the branch, if you shake the tree, you get the weak hands out. So the market's always going to do that. And depending on how many weak hands are at certain levels, you try to shake the tree. We got a little bit of that tree shaking today. But overall, market volatility is something I always talk about, but it's also indicative if you're buying options to understand that, or selling options, or you're just an investor to understand the expected range, what the market is pricing in right now. So one thing I want to take a look at, so the VIX, this is kind of tricky, but we'll go through this. The VIX, when you type in the VIX, just like I did here, that's cash settled index. I don't want to go too much into that. And then there's the VX, which is the volatility futures. VX is a better indication of what future volatility is. And if we take a look here on Thinkorswim here, they have this product depth. And if you take a look here at the futures, right now this is the interesting aspect of volatility. What we see here is volatility in the front month, right now in February, higher than the back month. This is referred to as backwardation. Typically, you'll see what's known as contango, which is down and out, down and up. This is backwardation, back and down, and that's opposite of what we normally see. And what that indicates is that volatility or fear is more uncertain right now than it is going out into June or May. Now, a couple reasons why that may be is we have the Georgia elections coming up, and we also have a disputed election, and something could come up in the next couple weeks where it really gets things moving around. So being that that's the case, and whatever scenario it is, it doesn't really matter the why, it just matters what is going on. And what we're seeing is that volatility is higher right now, especially in the front month, meaning fear is much greater right now than it is going back and down. So why this matters is the expected range is something that we can understand and be able to either sell into or even buy on the bottom. It's an expected range. It's almost a box, the expected range being that where the market has priced in. So if we take a look here, and what I'm going to do is I'm going to go back a couple days. I'm going to go back to the 31st here, and I want to show you why this is important here. So the expected range provides you the understanding of what the high and low will be in a certain time frame. We can all extrapolate that into useful and meaningful information to give us the best possibility or best expectation of what possibly is going to happen. So if we just take a look here at this time on 12/31, last trading day of 2020, and if you looked at 8 days here, so these expire on January 8th, the expected move at that time was $9.30. So plus or minus $9.30 from this level at 373 today. Now, if we take a look here at let's take a look here at the 5-minute. So we had a move up higher, and then we slammed all the way back down. For some people, they would say, wow, this is a crazy market, it's a volatile market. But we hit 364. On that previous close, 373, we had a $9 range that was expected. We moved within that range. And what that would mean to you is that, let's say you're long a position here, and we had this expected range. You got all the way down here. Would you sell at that point? No, what you would want to do here is that you would understand that that's the expected range, and that's where prices were going to bounce off of. This is exactly what happened. And that's why that expected range can be useful, because let's say you're looking for entry points. Well, that would be an entry point down here. Let's say you're looking for an exit point. Well, the exit point, then if you had that move, that 1 standard deviation move higher, then that would be something to sell into or understand. Now, this is on the SPY. You can use it for any option that you would choose. But if we take a look here at the SPY, and let's just go out to February. Let's go to a February expiration. You could see here on February on the SPY, at this point, we have on this expiration right here, February 19, 2021, the 27-point move higher or lower that's expected at this point, at today's close, that prices are going to go higher or lower 27 points up and down. We go out to March, it's 37. So we can start to get an understanding of where we expect the market to be. And this is why volatility is so important, not only to stocks, as I said, to stock traders and stock investors, but also option traders, because on Thursday last week, prices of those premiums were a lot lower than they are today. Now, if you bought options today and volatility comes back in, it drops a couple points, that's where you bought an option, nothing happens to that stock, but the volatility comes in, and that premium that you paid is a lot less than previous. And that's why it's important to always understand volatility, no matter if you're stocks, options, futures, every product has volatility. It's important to understand volatility. That's why it's always important, not only in 2021, which I think is going to see more volatility than we normally have, but going forward as well, which is going to help your trading, your investing, to understand those moves. So in the next video, we'll talk about another opportunity. But today, that's the most important thing going into 2021. And hopefully, it will help you understand the market much better going forward and make some money. So see you in the next video, and I'll talk to you then.